Okay, do we have sound? Hello? Excellent. Okay, let's get started. This is going to be a workshop on one of the requested topics that we've had, which is the financial system. One of the topics that we're asked to provide a matter prep session on. It's a bit of an interesting one because it's not really something that necessarily comes up a lot as a pure debate, but it's something that sort of permeates through a lot of things and can be clouded with mystery if we don't understand kind of some of the basic terms that lots of people are using. So this is essentially intended to demystify a lot of the stuff that people might talk about in the context of the financial system. I have a whiteboard, there will be diagrams, but I don't have a second camera, so I can't show you as I draw it, but we'll make do and see what we can manage. But basically, the financial system is the means by which people borrow and lend money. Everything basically boils down to those two things. Sometimes it's a little bit more strained. So when you're buying shares in a company, that is basically lending the company money, even though it doesn't feel like what we expect lending to be. But the entire financial system can be summed up in that way. What I'm going to do over about the next hour is explain a couple of key features. I'm going to try and explain the financial system by showing how it all collapsed. Because I think that's a good way of understanding lots of the different cogs that are operating in the financial system and things that can go wrong and why they go wrong. What I want to start with is a really basic look at where companies get money from. So if you're a company and you need to generate additional money to grow your business, you've got basically three options. You can, number one, go to a bank for a loan. This is pretty straightforward and everybody understands this as a way that companies would fund themselves. The bank gives you money. In exchange for that, you're giving the bank security, which is basically a right to take all of your stuff if you don't pay. So if you have lots and lots of stuff, the bank is probably going to be pretty happy lending you an amount of money that's less than that amount of stuff. And you'll probably get a reasonably good rate on that. If you don't have so much stuff, less likely to get an amazing rate. Another option for you is going into the bond markets. And this is much less complicated than people would have you believe. But basically, you might not want to go to a bank if A, you already have bank loans. If there's already one bank with security over all of your stuff, that bank could lend you more, but they maybe don't want to increase their exposure specifically to you being one company. So that might not be an option. And you could go to another bank, but the second bank is going to look at the first bank and recognize that the first bank has already got like first dibs on all of your stuff if you don't pay. So if you're not paying one of them, you're obviously not paying the other either, and the first bank gets to sell all of your stuff first. So the second bank's not in a very good position. So that's one reason you might look to a bond market instead. The other reason might simply be that you get better rates. Bonds tend to look more at the credit worthiness of you as a company. So for a really big company, it might be much cheaper to issue bonds rather than go to a bank loan if consumers have excellent confidence in your ability to pay back. This is what governments do, given that it's basically the safest way of you to lend money to someone is lend money to a government that can print money and pay you back. You're always going to get the money back. It may also be the option for you for the opposite reason, because you just aren't in a position where you can go to a bank and get a good rate, a good return on your investment. So you might go to bond markets instead if you're not quite big enough to be taking, if you need 150 million pounds and you're a relatively small company, bonds might be more attractive for you than a bank that's not maybe super happy with that arrangement. So the third option is shares, but we'll park that for now. So let's explain how a bond works. So a bond can basically be conceived of as a piece of paper with three characteristics. It's got a price, it's got a percentage, and it has a maturity date. So for example purposes, I really hope this is mirrored. Can somebody tell me if this is mirrored so that this is the right way around when I'm showing things up? I hope it is. A bond has three characteristics. It has the price you pay for it, which can hypothetically be $1. It has the year it matures, which I've scribbled 2040, and it has a percentage on it. So what this specific bond, the way this would work is a company, when it's issuing bonds, will charge $1 for every single one of these, and in 2040, it will give you that dollar back. And so this is this end and this end. And so you as an investor saying, I pay $1 to get this bond, and in 2040, the bond is cancelled and the dollar comes back to me. In the intervening time, for every year that I hold this bond, I get 3% of it, which is 3 cents in this example. So this would be paid usually half yearly, maybe quarterly. So you as an investor have a right to get your dollar back at a determined date in the future, and you have a right to a fixed income for that period. There are other types of bonds. They could be like X% above LIBOR or above another moving benchmark above Euribor. Or there could be no percentage attached to the bond at all. This is a bit more unusual, but you could have a bond that has 0%, and when the company sells it to begin with, you'd sell it at a discount. So you'd sell it for like 40 cents and say in 2040, I'll give you the full dollar back. But generally, they would carry percentages that are paying out. It makes them more attractive for investors. You get better rates. So this, when a company issues this, that is a bond being released in the primary market. Now you can see if I have this bond, which is basically a right to get 3% of my investment for the next 20 odd years, and interest rates plummet to 1%, so I can only get 1% anywhere else, then all of a sudden the ability to get 3% on investment is really attractive. So I would quite like that bond. I'd quite like to be able to be getting 3% of my investment. So I might offer to buy this of the person that got it in the primary market, and I might do that on the secondary market, i.e. after the bond has already been issued. Obviously, if you're holding something that's carrying 3% when other interest rates are only 1%, you're not going to be particularly enthusiastic about selling that to me for the dollar. So you're going to charge me more than that. So I'm going to pay you $1 and a couple of cents, maybe, to get something that is ultimately going to lose me money on a purely capital basis when I only get $1 back for it at the end, because I am calculating that the amount of extra interest I'm getting on this compared to what I would have received investing this anywhere else is worth it. Obviously, this can happen the other way as well. If interest rates soar and I'm sitting on a 3% investment when I could be getting 8, I want to get rid of this bond. But nobody's going to give me $1 for it because it's only given 3%. So I might have to sell it at 85, at 90. And when you factor in the number of different bonds with different percentages, with different maturities, coming from different companies that have different reliabilities, or coming from different assets which have different reliabilities, you can see why the bond market is relatively fluid, relatively liquid, and bonds are traded all the time. That is all people mean when they talk about bonds being traded on the secondary market. The bond is issued by whom? Another company. I don't fully understand the question. So bonds can be issued by anybody, really, but typically bonds would be issued by companies looking to raise lots of money. So if you have lots of different companies at different points through the year issuing more bonds, and as the year goes on, the going rate for a bond issue might change. So the one that I'm holding on to might no longer be as good now that bonds are getting more money. And it's all different companies. So company A might be like a big FTSE 100 company with a long track record can maybe issue a bond at 1%, whereas company B, that's a startup, maybe has to issue bonds at 9%. And everything else can be the same. The maturity, the coupon could both be the same. Huge difference purely based on the company. So you can speculate based on the chances of you getting that money back. Equally, the exact same company could issue bonds 1 year and then issue bonds again the next year with the same duration, same amount, but different percentages just because the market's changed. And that's why prices for bonds very, very rarely are sold at exactly the face value, at exactly what you would call par. So a $1 bond is almost always sold slightly more, slightly less, depending on how that's doing in the particular market at any given time. Bonds obviously can also be issued by governments. This is how governments raise loads of cheap money, because they can offer incredibly low rates on it. It's still attractive for some investors. Pension funds like it because pension funds want safe investments that they know they're going to get the money back. It's obviously great for the government, and why lots of governments borrow so much money just because it's incredibly cheap. So that's basically how bonds work. I'm going to try and fit this into a diagram which explains how the financial crisis happened, basically. And you need to understand bonds first to know how that happens. If there's any more questions on bonds, feel free to shout. So there are a couple of questions came in on the side. I'll presume that's a no. So we're going to start off in a new diagram. We're going to build this up gradually. So we're the bank. This is B. And the bank is sitting on a big pile of mortgages that's somewhere underneath. So the mortgages are providing a steady stream of income. If anything ever goes wrong, the banks take the house, sell it, and make up the money that they otherwise would have achieved if the mortgages were performing. But a bank might decide that, okay, look, I'll eventually get £1 billion off this big pile of mortgages if I wait for them all to steadily stream up into the bank. Alternatively, I could sell them now for, who knows, half of that, and have it completely off my balance sheet, so it's no longer my problem, and I've got the money now, I can use it to invest in more things. I could use it to issue more mortgages and get the fees for brokering mortgages all over again, and help, pursue more attractive investment opportunities. So what the bank might do is this. The bank wants money to come in and the mortgages to go out. So the mortgages are no longer the bank's problem, they've gone, and the bank has been put in funds. So this is a good solid whack of money. It's not as much money as the bank would have made, obviously, eventually, if it held on to all of the mortgages, but it is money now that you have. It's safe, you've got it, and you can use it to invest in other things. So to do this, they sell it into an SPV, which is like a special purpose vehicle. So this is basically like a shell company that's just been set up. That's terrible writing, but a shell company that's essentially just been set up to do this. This is the special purpose of that company, is to buy the money in, is to buy the mortgages in from the bank, so that the bank's position is gone. So this means that the SPV then has the homeowners sort of underneath, providing the steady stream of income from the homeowners that the bank gave the mortgages to, is now going into the SPV after this sale. Now, obviously, this company has just been set up, so it doesn't actually have the money to give to the bank. So the money has to come in from somewhere. And this comes in at the side from investors. So the investors are providing the money into the SPV that the SPV used to pay the bank to buy the mortgages. What the investors are getting in return is bonds. So I'll write that in here. So this is your full structure diagram of how mortgages were securitized. This still happens now, this happens all the time. This arrangement in and of itself is perfectly fine, there's nothing wrong with it, but this is the diagram where we see how a financial crisis happens. So the real magic that made this product so incredibly attractive is the tranching of bonds. So the SPV isn't releasing one bond to investors, it's it's releasing tranches that pay out differently. So it might have A tranches, B tranches, and C tranches. You could have as many as you want. You could go on to Fs and Gs if you like, but just for example's sake, let's have A, B, and C. So these are all, instead of going to one sort of pool of investors, this is essentially 3 different types of investors. They're all paying the same amount of money for one bond, but the different type of bond will carry a different percentage. So for the sake of nice maths, let's say 3, 6, and 10 or something like that. So you have safe bonds, medium bonds, and risky bonds. The reason that the A's are safe is because every month money comes in from the homeowners, goes into the SPV, and then is paid out. So when people pay their mortgage, the SPV, well, this is a shell, so it doesn't actually have things, but some of the money pays servicers and managers to perform basic tasks, which is allocating money to the A notes. Once they've all been paid their money, then you pay the B notes, and then once they've all been paid their money, you pay the C notes. So it's a waterfall. So every month money comes in, and the C notes only get paid if the A and the B notes have already been paid. That's why C carries the risk, and A, in theory, should be really safe. Because for the A notes to lose any money, the mortgagees would have to bring in significantly less income than was projected. And not just a blip, like obliterated, but bring in much, much, much less. This means that A notes got rated by the credit agencies with AAA ratings, i.e. the most safe type of investment that you could have. What this means is these now become attractive to pension funds who are looking for long-term safe investment and can realistically only invest in AAA stuff and safe, like FTSE, Dow Jones companies, because generally you don't take big risks with pensions as they're coming up to the time when you need to use them. So some portfolios will diversify and there'll be a bit of risk, which will be held by people who are younger. But when people's individual portfolios mature and they're about to retire, you want that money safe. You don't want to risk anything. So a steady 3% is great. Pension funds will love this because they're now getting 3% on mortgages, which is incredibly safe, right? I mean, everybody presumes that it's the first thing everybody pays off every month. You pay off your mortgage. This could never go wrong. So pension funds love this. And even down at the bottom, these are like hedge funds, big risk takers, private investors that with lots of money to burn. You're now looking, wow, I can get what, 10% on property. I'm getting 10% return on mortgages. And this is priced so that it's built in so that the C notes should always be paid, right? It's not a case of, well, if the mortgages do really well, the C notes will be paid, because it's not like shares which could go up or down. It's a fixed amount of money, basically, that you're expecting to have come in every month. So you price it so that there's even a little bit of money to spare to make sure that that will never be a problem. I'll try and block out the sun a little bit. So people down here are thinking this is excellent. This is a huge return on a relatively low risk product. What this does is fuel demand for the product. So banks are getting pretty good rates for this because investors are lapping this up and the money ultimately feeds into the bank. So the bank is going, goodness, I need to now find lots of more mortgages so that I can do this again. This was great. So the bank issues more mortgages, rinses and repeats this whole cycle, sets up a new SPV, sells a bunch of stuff into it, that sells on to investors. Everybody's happy, right? The bank is like got mortgages off its balance sheet, so it's no longer its problem, and it's got a huge pile of money straight away. The SPV is an SPV, it doesn't care. The homeowners are just paying your money every month, they don't care. And the investors are getting huge amounts of money on an investment that they think is really safe. So they're happy as well. So this product is awesome. Everybody loves it and everybody wants more and more of it. But eventually the problem is you run out of people to give mortgages to, right? You've already given mortgages to the people who are capable of paying it back. Bear in mind as well, this is driving up house prices the whole time. So house prices are getting inflated by how easy it is to get a mortgage and be able to buy a house. So demand is really, really high. So eventually, banks are giving mortgages to people who really can't afford them, like really, really can't afford them, bordering criminal, like bordering negligence, basically at times, by basically luring people in, particularly with teaser rates that are very low. That so you can, it's fine to pay for like the first 4 years, and then once the rate goes back to a normal price, it's really hard to pay, and you can't afford this. In the 2008 financial crisis, this House believes that governments should have bailed out the homeowners instead of the banks. We'll come on to that. There's a problem. There's a big problem with not paying out the banks, with not bailing out the banks. But sure. So basically, the way that the financial crisis happened, or the housing crisis, I should say, specifically happens, is here. I'll come to the question. A few people stop paying their mortgages basically because they can't afford it. They get hit with the higher rates, or they lose their job for whatever reason, can't afford to pay it. Whoever has the right to the mortgage, i.e. the right to be able to sell the house, then sells the house. It might still be the bank that's required to do that. This might be contracted out to somewhere. Somebody comes in and sells the house. That's fine to begin with. All of the money ends up in the SPV eventually, and the investors are still paid. But this keeps happening. So a few more houses have to be repossessed. Then all of a sudden, at the same time, banks are running out of people to give mortgages to, so the demand goes down, and the supply is increasing because the banks or the repossessors are selling more and more houses that they've repossessed, basically. So this drives down the prices of housing, and that's how the housing crisis specifically starts. This product here collapses because the C note holders start to think that there's not enough money here to be able to pay them, and in some cases this product fails. Not all, but in some cases this product fails. Some people will tell this story by basically saying this is all rubbish and everybody lost their money, which isn't strictly what happened. Basically, this sent fear up the system. So once some C note holders don't get paid, everybody up here panics and thinks, oh my goodness, this could even reach us in the A notes. And we need to sell these, so the price of this on the secondary market plummets. And nobody buys new ones. And even if banks try to issue them, nobody wants to buy them. The prices will be really low. And all of the money because the banks issuing mortgages is already one step ahead because they need to issue mortgages, then sell them. So the banks now have huge amounts of mortgages on their books that they budgeted for selling into this structure at huge prices, but now can't because this is tanked. This is no longer worth what it used to be worth. So banks are taking huge losses on their mortgage portfolios. Now, banks are also taking losses on derivatives, which I'll explain in a second, but this is more money coming out. I'll put a big D up there for money that they're losing on derivatives. Consumers are losing confidence in banks. So consumers are withdrawing money. We've seen this with Northern Rock when people are queuing up outside the banks to try and take money out of the banks because they don't believe that it's safe for the money to be in there in case the bank collapses. This part here of the banks not getting the huge income from the securitizations, losing loads of income in the derivatives market, and losing a bit extra to consumers withdrawing. This is kind of a bit minor in the grand scheme of things, but still doesn't help. This part here is the credit crunch. This is liquidity completely drying up in the market. So what that means is banks literally do not have the money. So when banks are, first of all, set up with a fractional reserve model, which, as you may or may not know, it basically means that they don't have anywhere near enough money to pay everybody if everybody tried to take their money out at the same time. Like when banks don't have liquidity, that means that banks, A, don't lend to each other which dries up the interbank market, which has a knock-on effect for consumers. But B, don't have the money to lend out to consumers or to businesses when they need loans. So businesses that need loans don't get them. Consumers that are looking for loans or mortgages or financing for a car can't get it because the bank doesn't have money. This is a credit crunch. This is a complete absence of liquidity or of money in the system. This is why chancellors around the world, central bankers around the world, dumped loads of money into the banking sector to stop this happening, to try and alleviate this as much as possible. A question comes up in chat: how can we argue for and against this? So, as in bailing out banks. So the problem with not bailing out a bank is it destroys basically most of the financial sector. So if you don't bail out the bank, think about everybody that's reliant on that bank. It's not just the bank itself. It's not the bankers with their mythical massive bonuses that they need to continue to get. Consumers have deposits in the bank. So ordinary people will have money in banks that they want to be able to get out. And if a bank goes bankrupt, they're going to struggle to do that. Some countries, including the UK, have government reserves set up specifically to insure against this. It's only up to a certain amount, and that's not true of all countries. It's something like 70 grand in the UK, I think. Other countries it's more, other countries it's less. But that's not necessarily like that much money in some contexts. If you have just sold a huge asset and are preparing to replace it with a new one, you could have money stuck in your bank temporarily, which is a lot of money. If you've just withdrawn a pension, in some countries, you can withdraw your entire pension in a oneer. I think you can withdraw about half of it all in one go in the UK. So you could just have taken a pension down and have basically your entire life savings sitting in a bank. That will easily be more than 70 grand. Even for like very poor people, will have quite a lot of money in a pension pot. A few £100,000 is not that much in a pension when you think about it. So there are loads of reasons why this is terrible for consumers. Bear in mind also, the bank has obligations going out here in the derivatives market. Some of these are to financial investors, fine, you might not care about them. Some of these are to pension funds. Some of these are to ordinary consumers. Again, this not being paid back is relatively catastrophic. It also pollutes other aspects of the financial system. So banks are relying upon each other for day-to-day liquidity. So at the end of each day, basically, banks effectively like pull together in the overnight market and swap around money so that money is being used in the most efficient way. The more money gets taken out of that, the worse it is for everybody involved that needs access to money, basically. So realistically, a bank collapsing is not an option. You can roll with it. Obviously, around the world, some governments chose to let some banks collapse. But it's a tricky decision to have to make because of the extensive knock-on effects that it has. Debate Intel asks why we didn't bail out the homeowners instead. That's a legitimate question that you could ask. There are two sides to it, and one is basically it's quite a political debate. As in, it kind of depends on how left/right wing you are, and I don't think there's much matter that you need to be able to make those arguments. I think you can see on the one hand why people losing their homes is bad. I think you can see on the other hand why people not being given assets that they couldn't own in the first place isn't a particularly useful use of government money in this time either. I think that comes down to political preference. So that is how, this is the housing crisis, basically. This is everything that happened in the housing crisis. I'm going to explain this bit here, and this is the really toxic bit that blew everything out of the water. Derivatives themselves are fine, but they can be used to cause carnage. So let's explain what a simple derivative is first. Derivatives are ways of swapping in and out of risk. So a simple example of a derivative would be a currency swap. So if you have an income that you know is going to be in euros and you have expenditure that you know is going to be in dollars, you're exposed to a currency exchange risk. So you need to be able to pay that amount of dollars with the amount of euros that you're coming in. And if the exchange rate goes in one direction, you might not be able to. So what you can do is enter into a swap with a bank, usually, or some sort of financial institution, um, where you pay the bank a set amount of euros and they give you back the right amount of dollars that you need. So this will be priced in a way that the bank should make a bit of a profit on it, but it moves all of the risk into the bank so that if exchange rates become very unfavorable for the company is shielded from that risk because it's already set its exchange rate at an exchange rate that maybe should have been slightly unfavorable, but shields it from a very unfavorable exchange rate. And from the bank's perspective, the bank can enter into this same arrangement in lots of different directions. So in some transactions, it wants the euro to do well, and other transactions, it wants the euro to do badly, so that eventually this balances its book, so that the projected small amounts of profit on each deal should net out and add up. So the bank profits, the company is happy because it's shielded itself against risk, everybody's happy with the arrangement. You can do this in a risky way by having all of your swaps going in one direction. So this is betting. This is rather than hedging, which is playing it safe. Betting is basically predicting that the euro is going to do really well compared to the pound and entering into all of your swaps in that direction to try and win big. That's when things start to become a little bit riskier, but again, not necessarily that problematic a product. Like people should probably be able to bet on currencies. Again, this comes down to your political persuasions, I suppose. But that's basically fine. That's not really causing a problem. It's just some people entering into a lot of risk. You can enter into derivatives on loads of things, on almost anything. So instead of currency, it could be just a rate on a loan. So if your loan is LIBOR plus 2%, and you know that you have expenditure of like 1%, um, or is it income, sorry, you need income more than LIBOR plus 2%, so income of like the equivalent of 7%, you might be happy to hedge that at a fixed rate. So you know that every month instead of LIBOR plus 2, you're just paying 3. So if LIBOR is low, you're losing out, and if LIBOR is high, you don't end up going bankrupt by not being able to pay your loan. So again, the hedge counterparty, so the bank in our previous example, would be able to enter into these swaps in all different directions. So it wants LIBOR to do well in some and LIBOR to do bad in others. And the company's happy because it's got rid of risk. LIBOR, by the way, is just a measure of how much it would cost a bank to borrow from another bank. LIBOR is actually lots of different numbers. It's not one number, so you actually have to specify. But it's basically built on a currency and a duration. So you can have an overnight sterling LIBOR. You can have Euribors as well in a euro context. Um, Fairly straightforward. So those are two basic examples of derivatives. You can have very bizarre things. You can have futures, which are very common as well. So a future is basically a contract to buy something at a fixed price in the future. So you could have an oil future that says in 2040, I'm going to buy oil at $100 a barrel, and both sides enter into that. And that can be traded, right? So in 5 years' time, if it looks like that, it's going to be awesome to be able to buy oil for $100 a barrel. If oil looks like it's going to be really cheap, I can sell that future to someone else and make a profit on it. This obviously the same works in reverse. If it becomes unfavorable, you can try and flog it for a cheap price, and somebody can look for a bargain. How about debates on regulation? This house would break up banks to make this house would nationalise credit rating agencies. Okay. financial assurances on the public. Assurance. I think assurance. Do you mean insurance? Herlin, do you mean insurance as opposed to assurance? So I was going to talk about something that's basically like insurance, which was pretty disastrous, and the problems with rating agencies and regulation. So that should wrap up both of those questions nicely if we check that you aren't talking about something different. So to finish on derivatives, you can basically swap anything. You can swap weather. That's quite a famous one. You can have an arrangement where you pay a bank a fee every month, but if the weather is really bad, they pay you loads of money to offset the risk of your crops not going very well. So an example in the sort of insurance context, and this is technically not insurance, and I'll explain why in a second, would be to enter into a credit default swap, or a CDS. So this is something that in this example, the SPV, am I not quieter all of a sudden? Is that, I'm not sure why, I'll turn the volume up if that helps. So something that the SPV could enter into would be a credit default swap in this diagram. This, I don't think this really happened much in reality, but basically what this would do is the SPV pays a small fee to the derivative counterparty every month. That just keeps ticking over. That's the cost of this deal. And in exchange, if the homeowners ever don't give the SPV the money that it's expecting, the swap counterparty makes up the difference. So this looks a lot like insurance, right? You're paying a small amount of money every month, and if this ever goes wrong, you get a huge amount of money back to compensate for it. So again, this is the SPV using a derivative to shield against risk, and someone else using a derivative to either hedge in lots of different directions or to speculate, to guess. So you could speculate and say, look, homeowners are always going to perform, this is safe, I'm just getting fees every month for nothing. And loads of banks entered into credit default swaps, loads of financial institutions did that. Now, the reason this is not insurance is because to insure something, you need to own it or have an interest in it. To enter into a credit default swap, you don't. So this meant that anybody could look at this arrangement and say, I want to enter into a credit default swap based on this. So I can be completely external to this and say, look, I'll go to a bank. I will pay you a small amount of money every month for as long as this keeps performing. And as soon as it doesn't perform, you're going to give me loads of money. And the bank is like, are you serious? Obviously, I'm going to take that. That's just free money. This is always going to keep performing. That arrangement, by the way, is the arrangement described as The Big Short in the film The Big Short. You're basically insuring this, even though you don't own it. And the reason that is so potentially catastrophic is because it made our market in effectively insuring the mortgages much, much bigger than the market for the mortgages themselves. But it also meant that the other side of those, so the bank side of the credit default swap, got put back into things that looked like this. So the bank is holding on to all of that income from credit default swaps. It's just free money every month because this is always going to keep paying, obviously, because it's mortgages. Everybody pays a mortgage. And the bank is thinking, oh, look, I've got a steady stream of income. I know what I can do with that. I can sell it into an SPV, get money for it now, so it's not my problem anymore, and sell it onto investors. So that arrangement, with instead of it being mortgages, it's credit default swaps. And instead of being homeowners, it's the fees on the swaps. They're just trickling in, and again, no longer the bank's problem. Now, the way that this gets really weird is banks start doing this with all sorts of crap off their balance sheet, and you can have CDOs. This whole thing is a CDO. You can have a CDS on your CDS. So this is basically insuring your pile of insurance, if that makes sense. So you've got money that's coming in from things that's like insurance, and then you can insure on top of this. So this is how you create a pyramid of more and more money being built up upon, presuming that the housing market is always going to be fine. And this comes onto the rating agencies point that's brought up down the side, is where the rating agencies get in loads of trouble because they keep giving the A notes AAA ratings, so pension funds keep buying them, even though this product is getting more and more risky. So the bank is looking for more and more stuff off its balance sheet, any old junk off its balance sheet to sell into these arrangements. The bank can even be selling in C notes from its own arrangements. So if it doesn't sell C notes because investors are like, look, that's a bit rubbish, bank will just buy them back cheap, repackage it, and if it buys enough of these from lots of different securitizations, it can put all of the crap C notes in together and bundle them into a brand new securitization. So it's all of the rubbish C notes that are bringing in the money. And the rating agencies still gave everything AAA because it was tranched, because they're thinking the A notes are probably always going to be paid because they're paid first. So you can keep putting more and more of a garbage product into a big enough pile so that the top tranche of it still looks attractive. And I mean, this has been quite a complicated explanation already, and it can get much, much more complicated. But these are the products that people are investing in. Pensions, investors, consumers are investing in these very, very complicated products that they don't understand because they have a AAA badge on them. Again, it's debatable to what extent rating agencies are to blame for this. On the one hand, they're giving AAA ratings to products that are just getting exponentially worse. Like, in addition to that, there's accusations of them being in bed with all the banks that are trying to sell these products because they're paid by the banks. The bank goes to the rating agency, gives them a pile of money to rate their notes, and you clearly have perverse incentives there to be giving favorable ratings when there's competition in the rating agencies. If S&P gives you a bad rating, you can go to Moody's instead next time. So the rating agencies can definitely take some stick for that. At the same time, it is still a reasonably performing product. It's not quite as bad as it sounds. It's pretty bad. It's not quite as bad as it sounds, right? Most of these products still perform for a long period of time. Even the garbage mortgages didn't perform that badly. I mean, they're bad, but they're not terrible. So you can sort of see how you can come to AAA ratings, even though they probably shouldn't have been. And you can also see why rating agencies just didn't understand these products either. That's a genuine problem when banks are able to pay more than rating agencies for the top performers in the financial world. So if you have clever bankers packaging up a big pile of crap to look really good, and you have, with the greatest of respect, slightly less able financial professionals working in rating agencies dealing with unbelievably complicated products, again, it's questionable what extent of blame you want to place on their shoulders. Again, debatable point. In terms of regulation, to prevent this sort of thing going very wrong again, rating agencies have been reformed to an extent, but not a lot. There have been other reforms which make exactly this problem a bit less likely to happen. So, for example, if we go back to the mortgage situation, there are now stricter rules on the types of mortgages that banks can give. So it's less likely that crap products end in the securitization. In particular, what you don't get very often, well, what you can't get in many countries now, including this one, is a really high loan to value. So that would be if you're looking to buy a house that costs £400,000, a bank can now, realistically, is now only going to give you like 90% of that. And there's regulation capping that at different levels in different countries. Like 100% is not uncommon as a cap. So if you buy a £400,000 house, the bank is only allowed to give you £400,000. Back in the good old days, banks were offering 110, 120, just because mortgages were the thing. They were making so much money out of the fees, and people were just not concerned about them not performing really, or they didn't care. Another thing which is designed to stop crap ending up in this product is risk retention, which is basically means coming out of here, you have like a Z note, which is held by the issuer, well, by the originator, so by the bank. So the bank has like 5% interest in this whole product, as in it gets 5% of the revenue and is required to retain that. So that's a reasonable amount of money that the bank has an interest in making sure filters down to it in the waterfall. So that's another example of regulation put in place to try and stop these products coming out looking really bad. I'm just going to check I've answered all of the questions that we have in that. Feel free to answer questions on that now if you have any. Because if not, we'll move really quickly on to something else. This house would nationalise credit rating agencies. Yeah, I feel like I've probably covered that. I think you can see. To be honest, I'm not sure that's balanced in a debate. I think in the real world, it probably is balanced, but I think in debating, it would be too easy to argue that rating agencies are corrupt and for people to just believe you, because you can show the dependency between banks and rating agencies. I think in the real world, I think you have all the standard nationalisation arguments against it about monopolies having no incentive to hire the best people or innovate, performance just not being that good, not hiring the best people. And also stagnation, like not thinking outside the box. So rating agencies do still have to compete against each other. And one way that they can do that is by publishing criteria by which they will rate things. So if you publish more clear guidance on what makes a product safe, that might make you more attractive as a rating agency. They also arguably compete against each other on the basis of being the most reliable. So the one that if they say AAA, it really is AAA. In reality, everything is pretty much the same. The criteria are almost identical across all of them. But if you only had one nationalized rating agency providing that, it's certainly, I mean, you don't have as much of an incentive to stay on top of that and make sure you aren't the one given duff ratings. How much would you have to hate everyone at the competition you're seeing to set a motion about credit rating agencies? Quite, yes. Like, that's what I mean. I think what I'm trying to do is give you an idea of how the whole system works so that you can talk about things like secondary markets or bond markets or mortgage securitizations without feeling like they're really alien terms and working out for yourself how you come to arguments. Because I really don't think it's that often that you get a debate explicitly on this. The nationalization of banks is basically the only one that comes up, or well, not nationalisation of banks, the breaking up of banks is the only one that I think is particularly prevalent. You have debates about whether or not you should bail out banks. I just think they're less good because I just think you should obviously always bail out a bank, but that might be personal preference. It's a more balanced debate to discuss whether or not you would break up a bank, because it gives you all of the arguments about why having big banks is really useful. And how that drives down margins and makes the entire economy grow more and makes everything better for consumers because they can afford cheaper loans and better rates on lending. Whereas on the other side, you have the same arguments against bailing out banks. One thing that I think is really interesting as well is how much people in debating love the moral hazard argument, which basically runs, banks know that they'll be bailed out if anything bad ever happens, so they are free to be incredibly risky. I think this is a really like funny argument in real life, but obviously it makes intellectual sense, so people use it in debates. But I mean, in real life, nobody is ever thinking, well, I'll lose my job and the entire economy will tank, but it's fine. It's not really that much of a risk. Of course, it's a massive risk. Nobody ever wants to be the one that invests loads of money in something really stupid and brings down a bank. No CEO wants to be in that position. No individual trader wants to be in that position. The other thing that's really interesting is the amount of hate that people have for bankers and their massive bonuses. Um, I think people will be surprised at the amount of money that bankers do actually make. It's not as much as it was 20 years ago, even at the very top of investment banking. And all of the big money is dependent on your prop trading bonuses, which is a very small percentage of your actual work as an investment banker. Um, which basically, what prop trading is over the course of a year, your bank gives you a huge pile of money, like tens of millions of pounds, to just invest in companies that you think will do well. And if those companies do well, you'll get a huge bonus. But I mean, arguably, that's not that problematic. If you make £1 million off a £60 million investment, and that's not impossible, and that's a huge amount of money for the bank. So you can see why they're prepared to give you half of that in a huge bonus. Whereas if you're not making any money off your prop trading, your actual salary is not that much for the rest of the job that you're doing, which is almost all automated and almost all just acting as a middleman and market making, which is basically when someone decides they want to sell shares, they come to you and say, find somebody that wants to buy this. And all of that is getting so automated now that the actual investment bankers are doing very little there. So they're looking to make money elsewhere in advisory roles with companies. Um, Certainly, the amount of money into that sort of intermediary agency brokerage work is way less than most people probably think it is. So I think that's quite interesting when people always talk about. I've seen a capping bankers bonus debate, and it's not as unjustifiable as people would argue that it is. I mean, obviously, there's two sides to it as well. It's still a huge amount of money, but just I feel like there's one side that the debating community is probably aware of, and another side of an argument that is probably not. Most investment bankers aren't making those huge sums of money. Any other questions on this? If not, there's not much time left. I'm going to very, very quickly talk about private equity, which is one of the only other things in this sector that I think has actually come up on a debate before. But I think we've pretty much covered off everything. We've covered off bond markets, we've covered off derivatives, we've covered off securitizations. These are all of the things that you need to be able to talk very intelligently in any debate about the financial system. No questions coming in, so I'll very quickly, wait, just as I say that, do you have any books or websites which you think would be useful for finance motions? Okay, that's an interesting question. I'm not really sure. I would recommend watching The Big Short, which is a very watchable film. It's quite accurate. It's not perfect, but it does give you a good idea. Even the dramatization of it, I think, is quite good at getting into the culture that was around at the time. The line I really like from that film is the Steve Carell line of "Why are they confessing?" When there's people bragging about the amounts of mortgages that they're selling to people that can't afford them, and he's asking why they're confessing, and the guy turns around and tells them they're not confessing, they're bragging. And I think that speaks a lot about this sort of culture that did exist when this product was just out of control. At the same time, I think that a slight problem with that film is, like, as inevitably happens with films, is some things get very simplified. So they use the simplified definition of a short, which is like, it is banker speak, and people basically describe anything which is a bet against something as a short, as opposed to a long. So you hold a short side rather than a long side. But that can be a bit misleading because that's not really what a short in inverted commas is, strictly speaking. And it also has a very, very favorable portrayal of the main characters who are buying these credit default swaps. So these are the people who are entering into the insurance contracts over products that they don't have. That's how they make all of the money in The Big Short. And they're being portrayed as the real heroes, or like the underdog doing well, when in reality, that is a product which made the financial crisis even worse, because that was bankrupting banks that were holding the other side of it. They were holding the long side of that transaction. So they were bringing down banks much further by holding those products, and yet they're portrayed as the sort of heroic protagonists of that film. But I think it does a very, very good job of explaining lots of those things. A website which is good if you just need definitions is like Investopedia. So if you hear a word that you don't understand, you can whap that up onto there and get a quick definition. Trying to think if there's anything else. There's a few books on like sort of life in the city as well, which might give you good ideas on some of these things. But I genuinely think if you understand more or less what I've said in this video, that's probably more than enough information you'd ever really need on these kind of things. Question on the moral hazard stuff. You were saying that it is still risky because you'll lose your job and ruin the economy, but isn't that the whole point? That won't happen if you're bailed out. Okay, but I mean, these are individual actors, right? So the bank itself will survive if you're bailed out. But if you've entered into trades that have lost your bank £10 billion, well, that's an exaggeration, that would never happen, but millions of pounds, then do you really think your job is fine just because a government has bailed out your bank? You're still probably being fired, or at the very least, you're certainly not making any bonuses that year, and you're going to be very unattractive to any other bank. So I think I just think the moral hazard argument undervalues people's desire to preserve their own reputation and their own job prospects. It's obviously not a completely useless argument. I accept, of course, that it's partially a thing. But that's my view on that. It's probably a personal view. Others might disagree. Question: can you make CRAs legally liable for bad credit rating agencies? I think there is a debate there. Yes. I think I'm not 100% sure, but I would suspect they already are liable to some extent if they do something that's like really outrageous. But I think that would have to be out of line with their own criteria. So basically what rating agencies would say is, look, we said we'd give this kind of product AAA rating. This ticked all of those boxes, therefore we gave it a AAA rating. We're not misleading anybody. We're saying this meets the criteria that we submitted. And the chances are probably all of these products did. Because the problem that the rating agencies are getting into are like accusations of collusion. And that's when there should, and probably is if it's ever happened, be criminal liability there. But in terms of being liable for bad credit ratings, potentially I think there is a debate there. I think there's arguments both sides that you can probably work out for yourself, right? I mean, like credit rating agencies are not going to want to incur risk. So it might be that they look to charge bigger fees for it, which ultimately harms the economy somewhere down the line, be it investors getting worse returns. But it also might mean that they just start producing incredibly conservative ratings. The reality is they probably start fudging stuff somewhere or another to try and get around that. But yeah, there probably is a bit of a debate there. Again, I think it's unlikely that an entire debate is set on specifically credit rating agencies, but you never know. Debates have been set on significantly worse things than that. So it might happen. Any other questions on this? Vastly running out of time, and I don't want to go on for much longer, but I will very, very quickly explain private equity, because I did say it's like one of the only other things in the financial system that does actually explicitly sometimes come up in a debate. So private equity is one of the final means of funding for companies, because it's money coming from the issue of shares or equities. They both mean the same thing, basically, a share or an equity. And there are lots of different ways that you can go to the market to try and get shares. You can have venture capital, which is sort of Dragon's Den situation of giving someone 30% for a certain amount of money. If you're that would be for a startup. If you're a really big company, you issue shares quite often and get new money in from new shareholders every time you issue new shares. That obviously dilutes the shares of your existing shareholders. So it's a fine balance between wanting to release lots of new shares to get lots of money in and not wanting to release so many that your existing shareholders become unhappy with the dilution. So there are various rules and regulations about the extent to which you can do that. But another thing that happens is somewhere in the middle would be private equity, and this tends to be a private equity fund coming in and you buy the entirety of a company looking to make quick money. The big danger with private equity is the desire to turn around a quick profit. So what you have is basically a time horizon of a few years, maybe something like 4 or 5 years. You're looking to get in and get out again, sell the company and extract money. So you can have accusations of stripping worth out of a company to try and make as big a profit as quickly as possible. And certainly during that time, a company is unlikely to be growing. It might do, because you can still make the profit when you sell the company down the line for a much bigger price. So that can be one way of doing it. So you might still have big growth, but generally the company itself is harmed a bit by private equity. This is not always the case. Sometimes this saves companies from ruin, but that's the complaint about private equity, is they're looking to extract money for themselves. But the other big concern is that private equity is very highly leveraged or geared, which basically means they use loads of debt. There are two reasons that you would do this, and neither of it is necessity. Private equity is not stupid and it's not short of money. So they aren't borrowing because they need to. They're borrowing because it makes so much more money to do that. There are two examples of how this happens. The first one, I guess, is kind of easy to explain. So you could buy a company that's this size and then sell it again when it's this size, and you make that amount of profit. So you've got that sliver in the middle. And this is presumably all that you can afford to buy of that company. But if this can get you this, then that also means that double that can get you double that, right? So if this is debt, so you've borrowed this to buy this, and you need to pay this back off, and you need to pay a sliver on interest. But instead of one buying you two, as in the first example, one has bought you, I guess, like three, something like that. So by adding the amount of stuff that you can buy, if you think a company is going to do really well, you can benefit much more by just owning more of it. So you take part in more of the game. That's one example of why leverage can be very useful. Obviously, that's dependent on the company actually growing and making that level of difference. The other example of why leverage is so useful is the efficiency of the spending of your profits. So if you imagine this graph as being profit over time, so this is time and this is money. So this is just a steady company, it's not growing anymore, and it's just getting this amount of profit. If you can buy as much of this profit as possible using debt, then your return as a percentage is more. So basically, when the company is spending this profit, you want a huge chunk of that to be spent paying off the debt. Okay, so you own all of this company, you've bought it all, but you probably paid like 5 or 10% of the full value of the company, borrowed all of the rest of it. That means that the company that you bought needs to pay that off over time. So almost all of the profits of the company are going to pay that off. But because profits are tax deductible and interest payments, no, I said that wrong again. Profits are not tax deductible, interest payments are tax deductible. That is more efficient. So even though you're keeping a small amount of the profit, as in this tiny bit here, this costs you very little to buy of your own money. Okay, the company costs the same amount to buy anyway, but of your own money, you put in not very much to get not very much profit. If you put in all of the money to get all of the profit, your percentage is a bit less. It's very hard to explain why that's true, but you'll have to take my word for it. I'll try and show that in a different diagrammatic form. So, so how do I show this? What you can have is a graph that shows the percentage of the company that you had to buy against the amount of money that the company is producing. That's a bit confusing, but basically, if I explain these two lines, the top line is still profit, okay? And the bottom line is the amount of the company that you bought with your own money. So if you buy very little of the company with your own money, the company suffers because it has to pay more interest back, but your profit margin is much bigger. Again, that's kind of hard to explain, but you have to take my word for it. And that's basically why private equity uses so much debt. And you can see why, if you're trying to get as close to the profit line as possible, that can be potentially bad for the company. If the profits dip below the amount of money that you need to be able to pay off your debt. You can also, from the last diagram, see why it's bad for the company if it's losing money through having to pay interest payments they otherwise wouldn't have. So that's hopefully a bit of an insight into some of the problems with private equity. I can talk more if you like, but I'll try and wrap it up once I answer all of these questions rather than going on, because that's been about an hour. Question, is high frequency trading a problem for the financial sector / bad for consumers? Do you think it will ever be relevant in debating? The second question is hard to answer because I think you can just never know when things like this will become relevant in debating, because I think this could be a very relevant example in, for example, a debate about mechanicalizing the workforce or computers, or maybe even artificial intelligence or something like that, because increasingly the high frequency trading is being done by computers. Individuals are not making high frequency trades, not really. Some are, but generally speaking, at investment banks and at hedge funds, you are taking time horizon positions of a few months as a minimum. Some hedge funds will go really long, like a couple of years. But generally, at an investment bank, you're looking to turn over in like 3 months. So traders in investment banks aren't doing high frequency trading at all. They are deciding this is a stock that I want to hold for a few months. The high frequency trading is being done by computers that are following algorithms, and basically what they're doing is taking the job of the intermediaries away from them. So it used to be, as I said earlier, that you call up your investment banker, say, I want to buy X shares in Y company at Z price. And the banker then tries and finds someone else who will do that trade with you and then takes a big cut out of that. But by big cut, I mean like 0.25%, something like that, which is pretty big when you're potentially dealing in millions. But now, so much of that is computerized. The cut that the middlemen are taking is way less, maybe 1/5%, something like that. and it's largely algorithms on computers performing that matchmaking. Now, if you know that there are algorithms on computers performing that matchmaking, um, you can develop other algorithms that will try and predict when a particular match needs to be made and try and buy that stock first and then sell it back when it's more expensive after the previous algorithm is trying to buy it. And then if you know that there's machines doing that, you can try and predict what those machines will do and get in before those machines. And this is kind of a never-ending cycle of different algorithms trying to top and tail each other and get into these positions as quickly as possible. Um, that is going to keep happening and is going to get, I say worse with caution because it's not necessarily a bad thing. It's just, it's happening. It's no different from a motives perspective than anything that a banker would be doing. It's just different in your capacity to enter into trades. So the danger, I guess, is that a computer can enter into like 10,000 trades a second. And when you're getting into that level of speed, really anything can kind of happen. You can lose control a little bit. But in terms of whether this can be bad for consumers, the argument, like, in reality, probably not, right? I mean, this is not the sort of thing that's realistically going to tank a banking system. I shouldn't really say that because we never really know what will be the next thing to tank a banking system. Maybe it will be computers driving down your ability to make profit on any share to basically nothing because everything is too fast to actually find room for profits in anything. But I can't see that as being like a number one concern for consumers in the banking system. I think there are many bigger problems. I'm just going to post a clarification to a question I've been asked on Facebook. There is a chat in the YouTube, by the way, if people haven't missed that. Are there any other questions? I'll see if I get a clarification on that. And if not, I guess that's us. That's been a bit over an hour, so I think we're probably done, but I'm happy to sit for a few minutes to see if any more questions come in. Feel free to ask away. No. Okay, I'll take that as a no. I hope that's been clear. I hope that's shed a bit of light on the financial system and the way that everything works and the way that everything can really not work if everything happens, if everything sort of goes wrong at once and everybody invests in risky products that they don't understand, and if everybody puts their eggs all in one basket and creates a housing bubble. All of those things are bad. Okay. Okay, one last question, it looks like. Why did the person in The Big Short get into a fight about whether or not to sell? Okay, I don't really want this to turn into like an actual movie review, but I did bring it up, so I guess it's my own fault. Can we explain this? So the guy in The Big Short, for anybody that hasn't seen it, as I say, he enters into the credit default swap that I was discussing earlier. And it's like insuring mortgage payments that he doesn't have any actual interest in. So as soon as as soon as the people with the mortgages don't pay, he gets a big payout. He didn't enter into one, so he would have entered into a huge pile of them, based on different bundles of mortgages, and not just mortgages actually, like default swaps, all different types of products that if they go bad, because I think, to be honest, what he was actually shorting was securitizations the of other default swaps rather than the mortgages themselves. But yeah, he has a big pile of them. So the reason that they got into an argument about whether or not to hold on to them or sell them now is because every time one of them goes wrong, he starts making a big payment. So you have an advantage to hold out for as long as possible so that more and more of them flip in his direction. Because even when he's getting lots of money in from some, he's still paying out the sort of effectively the insurance payment on all of the others, thinking surely the rest are going to go. The housing sector is collapsing. I could wait on all of the others going bad as well, and then they'll start paying me too. So the longer I wait out, the more will start paying me. The flip argument and why people wanted him to sell was because there was a genuine concern that the banks would go bust and wouldn't be able to pay. So even though they became required to pay, they would have no money left to pay with. So it's like, sell your position now to make sure you get the money. And what selling the position means is selling your right to all of those payments. So you're selling your own big pile of CDSs to someone else who's looking at all of the money that you're making from these CDSs, thinking, I want that. I will pay you a vast sum of money to buy the right to all of these payments off you. And eventually he did sell them because he thought that the amount of money that was being offered for the right to those payments what became eventually more than they were actually worth. So that's the debate about whether or not to sell now or to hold on later. I think a second question came in there as well, also on Facebook. Again, there is a chat function in the YouTube live stream if anybody wants to use that. Oh no, they didn't. Did I imagine that? Oh, okay, nope, I imagined it. Right, I think that's us. Thanks everyone, thanks for the questions and engagement. I hope that's useful. Have a good day.